All right, let's break down a huge day on Wall Street. It looks like Federal Reserve Chair Jerome Powell decided to play Santa Claus a little early this year, and he just gave the market exactly what was on its wish list. So let's dive into what happened, and more importantly, what it all means. You know, the market's been on pins and needles for weeks, but the Fed's decision? It was that perfect Goldilocks scenario. Not too hot, not too cold, just right. The signal was loud and clear. The economy is doing great, but not so great that the Fed's going to pull away the punch bowl. I mean, this was the absolute green light investors were hoping for.
And the reaction? Well, it was immediate and it was big. Just look at the sea of green. While the S&P 500 and the Nasdaq had some solid gains, it was the Dow Jones leading the pack with a full 1% jump. Now that tells you something, right? This rally wasn't just a tech story. It was a broad, market-wide celebration. So what exactly was the catalyst?
So what was inside this gift from the Fed? It wasn't just one thing. It was a really powerful three-part announcement, and each piece just built on the last one.
Okay, so this was way more than just a simple rate cut. It was a masterfully crafted package. First up, you got the rate cut. 25 basis points, a quarter of a percentage point. That makes borrowing cheaper for literally everyone. Second, and this is key, the Fed actually upgraded its growth forecast. They're basically shouting, hey, we're not cutting rates out of weakness, we're doing it from a position of strength. And then, the third part of the combo, they're injecting an extra $40 billion a month into the system. It's a triple whammy of good news. And that third gift? Well, the market already has a name for it. The bond king himself, Jeffrey Gundlach, immediately called it stealth QE. That's quantitative easing in disguise. To put it simply, the Fed is basically printing money to buy bonds, which floods the system with cash and pretty much pushes investors to go out and take more risks.
So, with recession fears officially on the back burner and a fresh wave of cash on the way, investors, well, they went on a buying spree. Let's take a look at exactly where all that money flowed.
Now this chart, it tells a really interesting story about risk appetite just coming roaring back. Industrials, the companies that literally build our economy, they were the top performers by a long shot. And at the exact same time, defensive sectors like utilities, which is where investors usually hide out during economic storms, they were totally flat. The message here is crystal clear. The market believes the coast is clear for growth.
And here is the proof, all in one number. 15.6. That's where the VIX, Wall Street's fear gauge, ended up after plunging 8% in a single day. When the VIX falls like that, it means traders are dumping their crash protection. That cloud of uncertainty that's been hanging over everything, poof, it just vanished.
And this rally wasn't just for the big guys either. The Russell 2000, which tracks all the smaller U.S. companies, also had a huge day. And since those smaller companies are a fantastic barometer for the health of the U.S. economy, their big jump shows that investors think this recovery is the real deal.
So yeah, the celebration was in full swing, pretty much across the entire market. But the day's full story, well, it wasn't really written until after the closing bell. That's when he got a little bit of sobering news that introduced a fascinating new wrinkle for investors.
And this slide just captures the new dilemma for investors perfectly. On one hand, you have the real economy absolutely booming. GE Vernova, a company that makes actual physical stuff, just soared 16% on fantastic results. But on the other hand, you get this warning shot from the world of AI. Tech giant Oracle plunged after its sales just didn't meet those sky-high expectations from the AI hype cycle. It's a real reality check. AI promise doesn't always translate to immediate profits. This split, right, this clear divergence between the booming real economy and the kind of shaky AI narrative, it sets up a really critical choice for investors now. So let's break down two potential strategies for this new environment.
So what's the play, right? Do you lean into this Fed-approved Goldilocks economic recovery and bet on the companies that are clearly winning today? Or do you start to play a little defense, maybe worried that this whole AI-driven tech rally is built on a shaky foundation?
Okay, this lays out two very different ways to play this market. The aggressive path is all about betting on the Fed's success. You could use an ETF like IWM to get small cap exposure, or something like Grid, which invests in the actual power infrastructure needed for the whole AI revolution. The big risk there is that just like we saw with Oracle, those AI profits take a lot longer to show up than people think. Now, the defensive path suggests a bit more caution. You could look at an ETF like RSP, which gives equal weight to all the S&P 500 companies instead of being so dominated by big tech. Or you could use XLI to focus on that industrial sector that's already doing so well.
And that right there is the billion-dollar question for every investor right now. The Santa Powell rally is real, no doubt about it, and the economic outlook is suddenly bright. But Oracle's results are a stark reminder that the massive AI-driven tech rally might just be getting ahead of itself. The party has definitely started, but the real question is this AI boom built to last, or is it just running on fumes?